On the markets and the strategy, Julian Emanuel joins us from Evercore ISI. You know, it's good if inflation keeps coming down, but the jobs market remains strong. We got 3 different points of evidence today. I'll include the challenger layoffs, which were also lower than expected, to show us that this jobs market is still tight.
Look, I think for professionals, this is always a difficult point in markets to, acknowledge the fact that good economic news is bad news for the stock market. And that's the paradigm we're in. And look, frankly, the Fed's been very upfront about its desire to get the unemployment rate to 4.7% by the end of 2023, to slow things down, to really rationalize the labor situation. But the point of that is that kind of jump in the unemployment rate, if we get there, has always catalyzed a recession.
So you have 41.50 year-end price target. That would be that'd be a rally. That's on the higher end. I mean, a lot of strategists aren't feeling optimistic this year. Why do you think that we can do that?
So for us, it's basically a question of an expectation of a shallow, shortish recession to arrive around mid-year. And frankly, when you think about it from a risk-reward perspective in terms of investing, that kind of activity, and again, no bear market has ever bottomed before the recession started. So from that perspective, we don't think October was the bottom.
Right.
But you get that kind of activity in the markets, the catharsis, volatility spike that clears the way for, in fact, the type of year that we expect, where earnings are going to be down, but the market's up. And the thinking is that is atypical. It's actually very typical. That's what we expect.
Well, if the Fed then moves into looser policy in reaction to recession, which we might not get this time.
So I think part of what Bullard left unsaid was, yes, there are only 2 to 3 hikes left. And that's something that the market will likely start looking towards, the pause. But we still think that kink in the curve, the expectation that rates are going to be cut, is likely an incorrect expectation, particularly if you get a situation where the recession is short and shallow. But the good news here is that stocks can still do well, even if we get that growth slowdown, as long as inflation is coming in, and we think inflation comes in at 3% this year.
What types of stocks?
So for us, we want to continue along the value line. We think basically value over growth has worked for the last year. That's a multi-year trend. We want to stay defensive.
That can work in recession, because a lot of those value stocks are also cyclical.
Well, so interestingly, consumer staples, which is one of our overweights, healthcare is another one, and frankly, energy, which you might not think works well in a recession, but the fact is the sector is already pricing in a recession at around 10 times earnings, that the rest of the market is not, and is 5% of the weighting with 9% of the earnings expected this year.
So I'm trying to think of